Okay, and so basically they've been using a mortality table way back in 1971. And we weren't living as long as we were then. I guess the Canadian government realized that because they finally decided to change things up. So now we're going to be using a new mortality table, and that's going to start January the 1st, 2017. And that one was published in the year 2000. So that is going to be used to calculate the taxable portion. Now, since we're living longer since 1971, our life expectancy, they're going to increase the tax rate on that. However, if you purchased an annuity before December the 31st of this year, you will still be able to use the more beneficial 1971 mortality table. Okay, even if the payments don't begin afterward. Now, I've done a few of these because this is a time right now where people would like to take advantage of the old tax law. If you want a prescribed annuity today, you can purchase one, and you can defer your income payment, keep it prescribed, keep the old tax laws, take your first payment sometime in December of next year. Okay? So you don't need to take an income right away. You can defer it, keep it prescribed, and keep it at the old tax law if you take an income by the end of next year. Okay? That's very important. Now let's look and see what the benefit is of annuitizing before this new law comes in. And as I mentioned, ladies, I do have an annuity rate for you, and this one is fairly new. It's for $100,000 for a male and a female. And I took different ages, 65, 70, 75, and 80. I plugged in $100,000 annuity. I put a 10-year guarantee on it. That's the annual income. As you can see, the older you get, the more you're going to get. The older you get, the more income you're going to receive. And also, you can see the difference in an income between a male and a female. And as I mentioned, men do win with annuities. Now, this is the rules that have been around for a very long time. That's the taxable portion. We have $510 here, and it gets less and less. The older you get, basically the tax just depletes. It goes to zero. Now, for a female, there's the tax there. They kind of do well here with zero. Now, here is the new taxable portion. It's basically doubling and even more at times. So if you waited till after January the 1st, the income is going to stay the same. It's going to be consistent. It's the taxable portion that's going to increase. Okay? I'll leave that for a second. Okay, I'm going to move on. Now, annuity rates change daily. I can go on the system, I can check the rates, I can call this company, call that company, and they're going to tell me what the rate is today. And then they're going to say to me, you have until midnight of the next day to lock in that rate. And so we would do an application, we would submit the application, we would fax it to them, and then we would express post them the application with the check. If they don't receive it that day, then we would just have to wait and see what the rate is when we would want to purchase an annuity. So they got strict rules about that. You just can't go in and buy an annuity and not commit to it and then say like a week later the rates go up, say, hey, you know what, I'm going to switch that. I don't want that annuity. Let's go with this one because the rate went up. Well, we can't do that. They want us to tell them that, yes, this is the rate we want. We want this rate locked in, and they will guarantee us that rate if they get all the information they need within the next day. Now, you don't have to lock in a rate if you don't want to. You can just basically say, look, by the time I'm ready to buy this, by the time I'm ready to submit the application, I'll just take a chance. Now, annuity rates do vary, but if it's within 30 days or so, the variation will not be that much. However, everybody wants to get the highest amount they can. And if you feel confident that that's a very good rate, then I think it's a good idea to lock it in. Okay, let's go to the next slide. All right. Now that's basically an overview of annuities. I'm just going to run through back-to-back annuities very quickly. This is a concept that's been around for quite a while. It basically takes two insurance products to achieve the rate of return that you're looking for that's going to beat other guaranteed investments such as a GIC. And it just combines two products, okay? One is a life insurance product, a permanent life insurance product that goes for the rest of your life, with a single life, no guarantee annuity. When you combine these two products, some good things can happen. So here's some questions you should ask yourself. Are you using non-registered fixed income investments to supplement your retirement income? If you are, this might be good for you. Are guarantees important to you? Do you want to preserve your wealth for you or your family? Most people do. Canadians have been doing that for years. Are you in a high marginal tax bracket? Do you want to maximize after-tax retirement income? Now, this strategy is most appealing to people who are retired or approaching retirement. Okay, they have invested significantly into fixed income investments, GICs, Canada savings bonds, etc., TFSAs, cautious with their capital. They're concerned that interest income is 100% taxable, which it is, and that's the worst investment to get, obviously, because it's the highest amount of tax paid. And they hope to keep their capital intact to transfer to their heirs. Okay, and that's what, as I mentioned, Canadians have been doing for generation and generation, is leaving money to their heirs, their children, most of the time. Okay, let's look at this person here. This is a gentleman that I met with 7 to 8 months ago. His wife had a life insurance policy with me. We started this way back. It was over 18 years ago. Unfortunately, she passed away, and her insurance policy was worth $1 million. Now, this person here was pretty set with his retirement income. He was in a high tax bracket. He wasn't looking to reinvest in dividends and any other stock portfolios. He was just looking for a guaranteed income for life and wanted to see what he could do with this money. So we took a look at his situation, and then this is what we drew up. And he didn't want to take any risks either because he had a lot already invested in the market. So he was looking to just basically keep his money guaranteed. So let's look at the right side of this. So what we did is we compared it to a GIC paying 3%. I cannot compare this to a stock or a marketable bond because that's not going to be guaranteed. I need to compare this to a guaranteed product since annuities are 100% guaranteed as much as the GIC is. So you're going to get your principal and your interest. So let's take a look at if he decided to take that $1 million and invest it in a GIC. So he's investing $1 million. That's his annual income at 3%. Now 3% is high today, by the way. You need to lock in your money for 5 years to get just less than that. Taxable amount, because its interest income is going to be $30,000. Now he was in the highest tax bracket, so $16,000 of that was taxable. There's no insurance cost on a GIC, so his after-tax income was $13,941. Now I'll come to the insurance cost in a second. So let's look at a back-to-back annuity. So let's go to the left side. He invested $1 million. His annual income was $71,266. There's zero taxable amount, so it doesn't matter what his tax bracket is. That's the insurance cost. Okay. Now, why does he want to buy insurance? Because if you have a GIC, you're going to get that income. Net will be $13,941. However, if he passes away, that $1 million will go to his estate, which will eventually go to his children or his beneficiaries. If he bought an annuity without an insurance protection, and if he passed away, that annuity, whatever is remaining, is gone. He's going to leave his children nothing. So what he's going to do is he's going to back up his annuity with an insurance policy. And that annuity is going to cost him $40,459 a year. Now, to get that rate, you need to qualify for the life insurance. And sometimes when you reach a certain age, it's pretty difficult to get. But I have done a few of these with people in their 70s, and they have received the insurance. Some have at a higher rate, some have gotten it at a pretty fair standard rate. Now, this person was in very good health. He got the insurance at a standard rate, cost $40,549 a year, $459 a year. His after-tax income was $30,801. So he's basically making over 112% more after-tax income from a back-to-back annuity over a GIC. If he didn't want to leave his children $1 million, he could even reduce his insurance costs and say, you know what, I'll leave them $500,000. And that would basically reduce the insurance cost to $20,000, which would give a net amount of after-tax income a lot higher. So basically, he's going to get this income for life. It's going to be tax-free. And if he passed away, his children will receive $1 million tax-free. Okay, this is the last one we're going to do. This was a scenario that came up a year and a half ago. Now, both 70 non-smokers. We need to know your smoking status, because with life insurance, if you're a smoker, you're going to pay about 25% more in premium. Both of them were retired. They're living off their pensions. Now, they sold their home because they wanted to be closer to their grandchildren. Okay, a lot of us want to do that, that's for sure. And the sale of their home produced $1 million in excess funds that they could be used to generate some income. So we also looked at a back-to-back annuity strategy for them. Now, this is going to be a little different from the gentleman that we looked at previously. We're going to be using a joint life annuity, so they're going to get an income for both of the husband and the spouse. The husband or the spouse will receive the income. Then when one of them passes away, the remaining spouse will receive the rest. So that's a joint life annuity. Then we're going to back it with something called the joint last to die insurance policy. That's a permanent life insurance policy. What that does is it pays out the insurance benefit when both of them have passed away, not when one of them has. So that way you keep your insurance costs down, because the insurance company has two lives to quote unquote underwrite, which means that they don't have to pay out after one person passes away. They're going to pay out after two people do. So let's look at the comparison on the right side. They were in a lower taxable tax payable bracket, so they were at 40% at that time. I think they're higher now. Anyways, their after-tax income was $18,000. So we look on the left side, and their after-tax income came to $31,972. They still got 75% more after-tax income using a back-to-back annuity over a GIC. And once again, the insurance amount is optional, whether you want it all insured or not. It's totally up to you, half of it insured. But basically, they're going to be paying $56,055 a year to the husband. He was the one who was the first annuitant. If he passed on, his wife would take those payments every year for the rest of her life. And once they both passed away, the life insurance would kick in and pay their beneficiary, and in this case it was their two children, $1 million, and that would be tax-free.